This is 11.3 lecture, Calculating Journalizing Dividends for a Corporation, found on page 328 of your book. Dividends are when you are paying a portion of your amount of money that your corporation has made back to the stockholders who own shares of stock in your company. So we need to figure out how to calculate the value of preferred and common stock. We always are going to pay out our preferred stock first because they have that special amount coming to them because of their ownership in their preferred stock. So to declare a dividend, the board of directors will distribute those corporate earnings to stockholders. It's not until a board determines that they will be declaring a dividend until then the corporation doesn't need to pay anything out or doesn't have a liability. There are 3 dates that you need to know about when you are distributing a dividend. First is the date of declaration, so that is the date when the board of directors declares that they are going to distribute a dividend. The second one is the date of record. That is the date that determines which stockholders are to receive dividends. And the last date is the date of payment, and that is obviously when we are going to actually pay the dividend to the stockholders. So the first thing we need to do is take however many preferred shares we have times the par value to figure out what our value of our preferred stock is. So our number of shares times our par value gives us the value of our preferred stock. Oops. Now we need to figure out the value of our common stock. So we're going to take our number of common shares times our stated value to get our value of common stock. So now we have both of our values, 100,000 for preferred and 320,000 for common stock. The next thing we need to do is calculate a dividend of preferred stock. So figure out what our value is times our dividend rate, and that will give us our dividend amount. So we had 100,000 in our value. That was our number of shares times our par value. That got us 100,000 value of preferred stock. If we take that times our preferred dividend rate, which has already been figured out for us, we know that we have a preferred dividend amount of $8,000. So that's what we are allowed to give out just in preferred stock. To figure out how much we can give out in common stock, we need to take our total available for dividends, which was that 24,000. That is what they have decided that they are going to give out in stock this year, or in dividends this year. We will subtract our preferred amount that we already figured out, and our amount that we are able to give out in common dividends is 16,000. Then we'll take our common dividend amount, 16,000, and divide that by the value of our common stock to figure out what our common dividend rate is. So when we take 16,000 divided by 320, we get 5%. So we know we can, our rate for preferred stock is 8%, and our rate for common stock is 5%. So this company may sometime elect to increase its annual dividend. The preferred dividend will never go over 8%. So if they increase their dividend amount, your common stock will rise, and common stock can be less, the same, or more than the preferred stock rate. So to journalize the declaration of a dividend, we need to do this on the declaration date. So that's that second date that we talked about. Or the first date we talked about, that date of declaration. We are going to debit our dividends common and our dividends preferred, and we figured those out in those calculations we just did. So we had 16,000 of common stock and 8,000 of preferred. So our dividends payable is 24,000. We just added those together. So what we do, instead of writing a check out to every person, every stockholder, every person that owns a share of stock in our company, we write this out just to one account called dividends payable, and that's just a special checking account, and then we write all of our checks to our shareholders out of that checking account. It's the same way when we do payroll. We don't write a check out of our cash payments to everyone. We write a check to our salaries payable or whatever, and then we pay each salary out of that checking account. Same way with dividends. Then we will go into our cash payments journal. This is actually on that payment date. We have our dividends payable that we are debiting of that $24,000, and we're doing a cash credit of $24,000 as well. And that is actually what we are taking out of that dividends payable amount. So the things that you need to know for this section are declaring a dividend, date of declaration, date of record, and date of payment.